This week we're going to first start with a bit of a recap on what happened last week, the key events, and then turn our attention to what's coming up over the next week. First, we had the Japanese GDP data confirm that they are indeed in recession. You can see on the chart they've in fact had, this is the fourth recession really in the past 10 years. So it's nothing new. I guess the intensity and the scale of it's quite significant, down 3.4% annualized in Q1 after a 7.3% drop in the final quarter of last year. So Japan in recession. Now, I want to turn our attention to some other developments. Of course, there's been a fair bit of discussion around the trade stoush between Australia and China over the past couple of weeks, with China imposing tariffs on barley and the threat of changing inspections regarding iron ore. But in fact, iron ore prices have lifted, and one of the reasons why iron ore has lifted is not only the fact that Brazil, there's the risk of supply disruptions coming out of Brazil as they deal with the coronavirus, but also the Chinese fiscal stimulus plan. So I just want to spend a few minutes just talking about the Chinese stimulus. While the Chinese at the National People's Congress over the weekend did not indicate a GDP growth target, they did in fact announce a fiscal package around about 500 billion US, 3.6 trillion yuan, equivalent to about 4% of GDP. And that's the blue bar here. That's this current episode. In 2008, in the financial crisis, Chinese announced a package worth about 13% of GDP. The pink bars on this occasion is the share of global GDP for the Chinese economy. So China now accounts for 18 to 19% of global GDP on a PPP basis, where it was about 12% back in 2008. So yes, it is a smaller package. China has less room to move than what they did previously. It's probably less focused on the sectors that are going to benefit Australia, but it is nevertheless still a sizable stimulus when you take into account the sheer size of the Chinese economy and the global scale. So it is a significant announcement, and one that does tend to benefit global growth. In fact, if we just do the maths on this, it would suggest that that package is worth about 0.8% of global GDP compared to the one back in 2008 of around about 1.2%. So a significant change. And so, materials is a sector that has benefited, as we can see here. I'm just going to put iron ore. So we're just tracking the performance of the materials sector since the peak in the equity market on February 20. You can see it fell by about 30%. It's now around about 8%. This is materials 8% shy of February 20 levels. So a strong performance. Iron ore, in fact, is about 5% higher than what it was back in late February. Now that compares to, and actually while I'm there, we should look at copper. Copper likewise has had a strong recovery after being down close to 20%, is now only down about 6% from those levels. So good performance from commodities, those commodities that are typically linked to stronger economic activity. Not all sectors have benefited, clearly. Utilities as a defensive sector has been obviously a lot more stable, but in fact materials now have pushed ahead, slightly ahead of it, which is interesting over this last 3-month period. But the bank sector continues to drag the chain. The bank sector is still down 35 to 40% in price terms from where it was on the 20th of February. So a major divergence in performance. So let's just now go and have a look at some of the other areas of discussion over the past week. And while we're looking at Australia, we'll have a look at the retail sales data. We saw the retail sales data for April come in at almost 18% down. That was after a 9% rise the previous month. So you can see the bounce, which was food related in March, and that was subsequently rebound plus some, reversed plus some in the April number. So retail sales down around about 9.5% on a year ago basis. Of course, the other headline grabbing bit of information was the error on the JobKeeper package, which now looks like it is going to around about 3.5 million rather than 6 million workers, which what that means in terms of dollars means the spend is going to be a lot less. So rather than 130 billion, it could be in the vicinity of around about 60 to 70. At present, that is, it does leave room for the program to be extended to those sectors that are continuing to hurt beyond September, and that is probably going to be the tourism, international tourism related sectors that will be able to access more of that sudden appearance of extra money. But as we can see here, so the way we're looking at this, we're trying to work out what the overall impact or the net impact on household income is from the decline in hours worked and the offsetting amount coming from JobKeeper and increased unemployment benefits. So, you know, when you look at household income on a quarterly basis, about 230 billion, that's the blue bar here, comes from labour income. There's about a $35 billion amount from social assistance. This is on a quarterly basis. And there's another 60 billion from other sources, which I haven't included in this chart on this occasion. So that's their actual numbers. The darker are the projected numbers. And, you know, based on 3.5 million accessing JobKeeper and also an extra 500, 600,000 to the unemployment queues, we might estimate, therefore, that labour compensation, direct labour compensation, could fall by 20-25% over the current, you know, at the present time in the current quarter and September quarter. So that explains the fall away in the blue bars. But as you can see, that's being made up by the roughly 30 to 40 billion that's going to be sourced, or possibly more, for say 40 to 50 billion that's going to be sourced from JobKeeper and also the increase in the unemployment. So it basically leaves the income profile roughly the same, although we have it tailing off. Probably the most important piece of the jigsaw will be what happens to the savings rate. We already saw in the US the savings rate jump to 13% from around about 6 or 7%, so a big climb. We could well see that in Australia as well, somewhere into the mid-teens, as the sort of fairly steady levels of income with little opportunity to spend, and of course added uncertainty leads to a hike in the savings rate. We then have it falling back towards 6. But this is probably the key in terms of the flow of spending over the near term. So we're not as optimistic on the income side as others have suggested. Income's probably not likely to get the big bulge that some might have thought, but likewise it's not falling off significantly. So that's some comments there. We also had the US housing data out last week, and just in terms of an update, housing starts, which is the blue line here, were down, the red line, down 30% to levels not seen since 2015, 30% in the month of April. More recent data from the Builder Sentiment Index has it actually lifting ever so slightly in the month of May. So perhaps that's a sign that we might see some slightly better housing data coming out of the US, but very early days at this stage. So that's sort of a sum up of some of the key announcements. We also had the Bank of England talking about the potential of negative rates. We had the Fed fund futures, over recent weeks dipping into very, very slight negative territory. Yet the Fed continues to argue that it's unlikely to move in this direction. And then, of course, while on the topic of China, we had the talk of the imposition of national security legislation in Hong Kong, leading to, once again, an escalation in protests. And that is causing some concerns at a global level. I just want to finish off with just a quick look at some other charts, just looking at the importance of the Chinese economy. So we already talked about the size of the fiscal stimulus being smaller, but China's a bigger pie, so it does have an impact. And I guess that's once again represented in this chart that looks at China's role in the global economy and how it's changed over time. This again is on a purchasing power parity basis. So back in 2011, China accounted for less than 14% of GDP. You can see now it's accounting for 18, 19. And at the same time, the role of, this is Europe, has continued to decline. Almost the mirror image of the rise in China, and the US remains still obviously a big component. The other line on this chart is the contribution of Chinese investment spending as a proportion of total global GDP. So that has gone from around 6% to 8%. So whatever China decides to do on the investment side has a significant impact on global growth. What about for Australia? And this is probably not only important from the point of view of China's stimulus package, but also from the current escalation in trade between Australia and China, and just the importance of China is to the Australian economy. And so just a couple of charts to remind us of some of the key stats here. Firstly, Chinese exports of goods account for about 35% of our total exports. And you can see there just how dominant China is in the export side, and obviously a lot of that's in the mining sector. If we look at the service sector, we see a very similar pattern. Dark blue line is China. China accounts for around about 18-19% of total services exports, and that has been growing steadily in recent years. And in particular, there's been a lot of talk about the impact of the shutdowns on both the university sector and just tourism more generally. And we can see here that China's share of education exports, which is a big export for Australia, accounts for about 33%, so a third of Australia's education exports from China. And more generally, I suppose, travel or tourism exports, China accounts for about 26%, encompassing that as well. So very significant in terms of the impact of Chinese growth going forward, or any concerns on the trade front. So thank you for listening today. Thank you.